Well, g'day there again, traders and friends, market participants right around the world. I just wanted to bring to your attention also one rather interesting signal that has been more or less given as at the close on Friday. This is a chart of the Russell 2000. When we talk about market breadth, or at least encompassing a greater number of active trades housed within an indice, we generally look at the Russell 2000. It gives us a better understanding of, the strength or potential weakness underlying what the markets are doing. Now, what is important about the Russell is that it has been in a long-term consolidation within this range. I mean, really since December 2016, we have been more or less stuck between 1,420 and also this lower bracket down here at 1,350. So we've been seeing a lot of sideways choppiness in this overall market, and this is what we call consolidation. It's very important that you understand consolidation. Now, generally, the word consolidation, it goes, we can break it down into essentially two categories, either accumulation or distribution. One, of course, is when we're talking about accumulation. That is when we're at least expecting the market to break out and to continue higher. It is a rather long, elongated buying pattern. Otherwise, there is the other essential pattern, which is called distribution. Now, distribution generally happens up and around resistance, up at new all-time highs. And again, this is more of the smart money, the institutional money selling or distributing their positions to, the potentially the uneducated or misinformed market participants. Now, accumulation and also distribution, they occur at different locations on the chart. Generally, when we look at these types of long sort of sideways rectangular patterns, the location where it is occurring is generally, the term or the essentially the location itself is where we give the consolidational pattern its name. And again, just to coincide this or to bring this full circle, resistance often coincides with distribution, and accumulation often comes with a bear market or the end of a bear market where you're down towards the lower bracket after a rather large retracement, a correction in the market. And then again, the institutional money begin accumulating their positions where sentiment itself is most bearish. Flip that on its head, and when you're up at resistance, again, sentiment is most bullish. And this is where, again, the institutional smart money start distributing their positions to the misinformed, okay? But going full circle, essentially, to what is occurring on the Russell, generally in this context, you would call it a distributional type of pattern. However, what is interesting about this is that we have broken to the upside. So it looks as though we are setting up the beginning of a new trend. However, this candlestick, which has just presented itself on Friday, is rather interesting. This is what we call a shooting star type of reversal signal. So generally what happens is when you see a breakout of this magnitude, again going back to 2016, you want to see the market really flow through. And generally what you don't see after such a long sideways market is to see these types of signals immediately or very soon thereafter. Again, this is what we call a shooting star candle. And what you must pay attention to on the Russell 2000, again, breaking down market breadth, is that this is a very, very strong sell signal. It almost sort of resembles that of a fake sort of breakout, or what we would essentially call a whipsaw, if in fact we see the continuation of this pattern playing out, and that would essentially be the break of Friday's low in a very violent sell-off. So I mean, it's something to pay attention to. It doesn't necessarily sort of mean that there is a top whatsoever in the Russell 2000, but generally when you see this signal after a breakout of such a long broad basing pattern, or what has been a long-term consolidational pattern, bad things essentially happen. And what I mean bad things, I mean you're talking about lower prices. I just wanted to bring that to your attention because, again, this is a very alarming signal, and it's important that you understand how, again, market breadth flows into the market and why market breadth is so important. Now, also on top of that, if I go to some of these weekly indicators, you can see divergence. I mean, divergence is a subject that I've been speaking about until really I've been blue in the face or red in the face, so to speak, because we haven't seen any of these divergences really play out. I mean, it doesn't matter which fractal you go out onto, but even if I go out, I mean, even onto the monthly chart, you can see this establishing itself since 2013, 2014. This is the monthly divergence of that between the Russell and the coinciding peaks that we've seen in terms of price. You can see these market waves of pushing up and then retracing and now pushing back up. But what's happening definitively across the board is that we are establishing divergence in the MACD. So generally what we want to see in terms of confirmation is to see structural damage done technically. And to bring this full circle, to see the structural damage done, you really need to see the Russell pull back aggressively. And the level which you essentially become concerned about is down here at 1,329. Now, obviously, that's a very long way to where we are currently sort of printing at and trading at. But It all starts with a couple of daily signals, all right? All of these, sort of larger macro eventual trend changes or macro trend changes will essentially start with a couple of daily candlesticks, a change in sentiment, a shift in sentiment, and this is potentially, a candlestick which may indicate a larger pattern at play. And again, it's important that you understand this. Going into silver also, I spoke about this on a previous video. The trend in silver and also gold is down. We're making a collective series of lower highs and lower lows. A lot of people, again, are getting excited about this current jump, this bounce to the upside. However, even if you pay attention to gold, and if I go out on the weekly chart, you have to respect this downward sloping trend line. This is very important. Every time we bounce into it, we find resistance. And this is no man's land. So please think about no man's land. I described it over here as well as to what you shouldn't be doing, or you shouldn't aggressively be bullish until we definitively break above this downward sloping trend line. Well, the same is true right now. Please don't be swept up by the emotion going on with gold and silver at this particular point, because we are in no man's land. And I just don't want you to make foolish decisions on commodities at this particular point. Also, just to let you know, this is coinciding with the base in gold. Sorry, not gold, but the US dollar. So we've got, I guess, a confluence, or multiple areas of support coming close or in very close vicinity to one another. So as commodities once again push up into their respective resistance areas, you can see, again, this is coinciding with the US dollar and the inverse relationship that the US dollar has in terms of purchasing power of silver and gold, also establishing or potentially establishing its macro support as well. So something to keep you updated on also. So enjoy your weekend, everyone. I'm going to finish this render, close down this video, and enjoy my weekend. I wish you all a very nice weekend, and I'll see you over in the upcoming week as well in the world of financial markets. Goodbye, everyone. On behalf of Pivot Point Trading, this is James. Farewell.